welcome to the deep dive. It feels like the market's been throwing us some serious curveballs lately.
Yeah, definitely.
And you're probably feeling it too.
Yeah,
Just a lot of volatility, a lot of uncertainty out there.
for sure. Seems like the main topic of conversation
It
everywhere.
really does.
Yeah.
So our guide for making sense of it all today is this set of 15 extreme charts for April 2025. They're from Lucas Downey over at mapsignals.com.
Ah, okay. Map signals, yeah.
Think of this as like your shortcut to understanding these wild swings we've all been seeing.
That's a good way to put it. These charts, they just came out April 10th, 2025, and they really, they zero in on some pretty significant market moves.
Right.
The kind of stuff that's probably grabbing your attention, and well, for good reason.
Exactly. So our mission here is pretty simple.
Yeah.
We're going to dig into these visuals, pull out the key data points, and try to weave in some historical context. Just to give you a clearer picture of what's actually happening beneath the surface. We want to equip you with the essentials, without burying you in endless details. We know you're busy.
Right. Cut through the noise a bit.
Yeah.
And what really jumped out at me in Downey's report is his statement. He says, what we are witnessing today will be remembered for many years to come.
Wow. Okay. That's a strong statement.
It is. That kind of conviction, it makes you sit up and really pay attention to what these charts might be telling us.
It does. And let's be honest, the burning question on everyone's mind right now is just, what's next? What's next for my investments?
Absolutely.
So this deep dive is all about tackling that question head on, using the actual data presented in these, extreme charts as our roadmap.
And there's even a hint of the unexpected, isn't there? The intro to these charts, it kind of teases that it's possible that the unthinkable could occur.
The unthinkable. Okay, that definitely adds another layer of intrigue, makes you want to see what kind of scenarios the data might be pointing towards.
Yeah, exactly. Keeps you hooked.
Okay, let's unpack this then. Starting maybe with the big picture.
Yeah.
Equities. Chart number 1 shows the S&P 500 has taken a pretty big hit,
Yeah, a big one.
dropping nearly 19% from its peak. Now, to put that into perspective, this kind of decline, it's not like totally out of left field historically.
Okay.
If we look back at the average market correction since, 1965, this fall is actually getting pretty close to that average.
So painful, yes, but within historical norms for a correction, potentially.
Right. So while it feels dramatic, history suggests it's kind of within the normal range of, market ups and downs.
But what's really fascinating here, I think, is not just the amount of the decline, but the speed of it. Chart 2 really highlights that.
To speed, okay.
Yeah, the S&P 500 experienced one of its most rapid two-day drops ever recorded. A staggering 10.5% fall.
10.5% in 2 days.
Wow.
Yeah.
That kind of swift, sharp movement, it can really rattle investors, understandably.
No kidding. And chart number 3, that gives us some crucial historical context for these kinds of sudden drops, right?
Exactly. It looks at what tends to happen after the S&P 500 has a really bad day, like, say, a drop of 5% or more.
Which we actually saw recently, didn't we? April 4th.
We did. April 4th, 2025, it fell 5.97%.
Wow.
So qualifies for that. And the chart also looks at those more extreme two-day plunges, like the 10% plus one we just mentioned.
Okay, so what does history say happens after these big drops?
Well, connecting this to the bigger picture, the historical data is quite compelling, actually.
Wow.
Following that 5% plus single-day drop,
Yeah.
the chart indicates that, on average, the market has seen double-digit gains in the 6 months that followed.
Double digits in 6 months. Okay.
Think of it like maybe a coiled spring potentially releasing energy. And when we look at those really rare, significant two-day drops,
Like 1987, 2008, 2020 kind of stuff.
precisely, those kinds of events, the report points to massive market gains in the 6, 9, 12, and even 24 months afterwards.
Massive gains. Okay.
It suggests that these really sharp declines, as painful as they are, can actually create significant buying opportunities down the line, for patient investors anyway.
That long-term historical view definitely offers some reassurance. But then, just when you think you have a handle on the downward trend, we saw that big bounce, right?
Right. Chart number 4 highlights that. On April 9th, the S&P 500 suddenly jumped 9.5%.
9.5% up in 1 day.
Yep. Which the report calls one of the largest pops of all time.
So naturally, this immediately makes you wonder, is this the start of a real recovery? Or is it just, a temporary bounce, the old dead cat bounce question?
That's the million-dollar question, isn't it? Everyone's trying to figure that out right now. Chart 5 actually digs a bit deeper into these large single-day gains.
Okay, what does that show?
It looks at all the instances since 1979 where the market jumped by 6% or more in a single day.
Right.
And what's really striking is that in every single one of those cases, the data shows stocks were significantly higher both 1 and 2 years later.
Every single time, 1 and 2 years later.
According to this data set, yes. It suggests these powerful upward moves. They can be pretty strong signals of longer-term positive trends. Not guarantees, obviously, but strong signals.
Interesting. So we've seen a hard fall, then a big jump. Now let's look underneath the surface a bit. What about money flows? Chart 6 talks about outflows, right?
Yeah, and not just any outflows. It points to some of the largest outflows ever from equities.
Ever. Wow.
We're talking nearly 1,000 individual stocks being liquidated. That's a level of selling pressure we haven't seen since the really panicked days of the COVID-19 collapse back in 2020.
That really puts it in perspective. It emphasizes just how much de-risking, how much selling has been going on.
It does, and it raises an important question. What does this kind of extreme exodus, this flight of money from the market typically mean going forward?
Yeah, what does it mean? Does Chart 7 shed light on that?
It tries to. It offers some historical perspective. It shows that when equity outflows have exceeded 600, which is a sign of really significant selling pressure, it's historically happened during very, trying times.
Makes sense. Like now.
Exactly.
Yeah.
However, and this is the key takeaway here, these periods of large outflows have generally been followed by the market delivering market-beating gains.
Market-beating gains.
That's right.
For which stocks?
For small, mid, and large cap stocks in the 12 months that followed.
So it's almost like peak panic selling might create a bottom.
It seems like maybe investors might be overreacting in the short term. Yeah, potentially setting the stage for future gains once that selling pressure exhausts itself.
That's a really interesting dynamic. Okay, let's shift gears slightly. Let's talk about market breadth. Chart 8.
Right, breadth.
Yeah.
Basically, how many stocks are participating in the move?
And this one focuses on the S&P Mid-Cap 400 Index. It shows just under 12% of the stocks in that group are currently trading above their 200-day moving average.
12%? That's not a lot.
Not at all. Yeah, and the 200-day average, that's a common way people gauge the longer-term trend, right?
Yeah.
Above is generally seen as bullish, below is bearish.
Correct. So having only around 12% of mid-cap stocks above that key level, that's the weakest reading we've seen since June 2022.
Okay.
It indicates very weak overall participation in any upward movement, at least in that segment. You could think of market breadth like how many individual boats are rising with the tide.
Right. If only a few are floating above their long-term lines, the overall tide isn't very strong.
Exactly. The upward move isn't very strong or widespread.
But is this just a mid-cap thing?
No, that's the thing. Chart 9 tells us that virtually all major indices are washed out like this.
Okay, so broad weakness underneath.
Yeah, this underlying weakness is quite broad across the market. But again, there's a potential silver lining, historically speaking.
Oh.
Chart 9 also points out that after similar periods of really low breadth in the mid-cap index, where so few stocks were above that 200-day average, those mid-cap stocks were never lower, 12 and 24 months later.
Never lower. That's pretty definitive sounding.
It is. Based on the historical data presented, it suggests that these deeply washed out breadth conditions can actually be a signal that maybe a turnaround might be on the horizon.
So we're seeing big price drops, money flying out, few stocks participating. It's probably not a surprise then that volatility has spiked. Chart 10.
Yeah, chart 10 shows the VIX, the CBOE volatility index, often called the market's fear gauge.
And it closed above 40.
It did. That's a level of heightened anxiety, that kind of nervousness we haven't consistently seen since the really uncertain period back in 2020.
Okay, VIX above 40 feels scary. What's the historical context there? Chart 11.
Right. Context is crucial with the VIX. Chart 11 provides that. It looks at all the previous times since 1990 where the VIX closed above 40.
How many times was that?
There have been 203 such instances, according to this chart. And what's really remarkable is what happened after these high VIX readings.
What happened?
In the 12 and 24 months following these high volatility closes, both the S&P 500 and the NASDAQ Q100 have historically delivered market-beating gains.
Again, market-beating gains.
Yes, and with a very high hit ratio, as the report puts it.
So while high volatility feels really unsettling in the moment.
Exactly. History suggests it has often paved the way for strong returns down the line. It's counterintuitive, but the data seems to support it.
That's a really interesting pattern to keep in mind. Okay, what about value? Are stocks looking cheap or expensive right now? Chart 12 touches on valuations.
It does. It gives a snapshot as of April 7th. It notes the forward price-to-earnings ratios.
Right, the PE ratio looking ahead.
Yeah, basically how much you're paying for expected future earnings. For small, mid, and large-cap stocks, these ratios are mostly below their 20-year long-term averages.
Below average, so potentially better value.
It suggests that, yes, at least based on how much investors are willing to pay for future earnings, stocks might be offering some relative value after these recent declines. When these forward PE ratios are below their historical averages, it can indicate investors are maybe less optimistic about future earnings.
Which could create buying opportunities.
Exactly. It can create more attractive entry points for investors who have a longer-term perspective and maybe believe in the potential for those earnings to recover.
Makes sense. Now, chart 13 shifts gears a bit, back to money flows.
Yeah, it emphasizes that fundamental principle, supply and demand. Where is the big money actually moving?
And according to this chart, where are we?
We're currently in what's described as phase 4.
Phase 4, what's that mean?
It's characterized by basically non-existent buyers and dominant sellers.
Oof. Lots of selling pressure, not much demand.
Pretty much.
Huh.
And the report stresses that in this kind of environment, it's really important to focus on where the market is likely heading, not just obsessing over where it is right now in this, phase of selling pressure.
Like, man.
And this brings us to where the author suggests the unthinkable is possible. Chart 14 draws this really compelling parallel.
Between now and when?
Between the current violent sell-offs and similar sharp downturns we saw back in March 2009.
Depths of the financial crisis.
Right, and March 2020, the start of the pandemic shock.
Okay, what's the parallel?
In both of those prior instances, an indicator called the Big Money Index, or BMI.
BMI, okay. What's that track?
It's designed to track the buying and selling activity of large institutional investors, the big money. In both 2009 and 2020, the BMI plunged into oversold territory right around the time the market hit its maximum drawdown.
Bottom, essentially.
The point of deepest decline in those periods, yeah.
And the chart highlights something fascinating that happened after those oversold conditions, right?
Mm-hmm.
Particularly in 2020.
Yes. An unthinkable overbought market emerged relatively quickly.
Unthinkable overbought. So it flipped really fast from extreme fear to, maybe extreme greed or optimism.
Exactly. It really underscores just how rapidly market sentiment and momentum can shift. It's almost hard to imagine when you're, stuck in the middle of a sell-off.
Totally. So where is the BMI now? Chart 15.
Chart 15 reveals the current level. While the exact number isn't specified in our notes here, the author's analysis suggests that, based on the recent intense selling pressure, the BMI seems likely to move into that oversold territory pretty soon.
Okay, so potentially heading towards that oversold signal.
Seems plausible based on the trends.
And there's a bonus chart, number 16, looking closer at what happens when the BMI does get oversold.
Yep, chart 16 digs into that. Interestingly, it's only dipped into this oversold green zone, as they call it, 25 times since 1990.
Only 25 times, so it's a relatively infrequent signal.
Pretty rare, yeah. And what's historically noteworthy is the typical pattern around these oversold periods.
What's the pattern?
The chart indicates that stocks often tend to dip a bit further, maybe as those big institutional sellers finally, exhaust their selling, right as the BMI enters that green oversold zone.
Okay, so a fine little dip, maybe.
Potentially. But then the market has historically tended to experience a significant upward move, what the report calls a rip, in the months that follow.
Oh, rep higher.
Yeah. So it suggests that while hitting oversold might feel like the absolute bottom, there could be some short-term wobbling or even a final dip before a more substantial rebound takes hold.
Okay, so let's try and bring this all together.
Yeah.
We've definitely seen, as the report says, some of the most extreme events in equities.
No doubt about it. Significant price declines, massive outflows, very weak breadth.
And that big spike in volatility, the VIX over 40.
But, and this is the crucial part, we need to remember the historical context that these 16 charts provide.
Right.
We have navigated similarly turbulent, similarly painful periods in the past. And the overwhelming message from the data seems to be that eventual recovery and often significant gains have followed.
And the author, Lucas Downey, he seems pretty convinced.
He does. He firmly believes that money will eventually find its way back into stocks, and that this big money index, the BMI, has historically been a pretty reliable indicator of when these important turning points in market sentiment are likely to occur.
So ultimately, this deep dive into these extreme charts, it hopefully offers you, the listener, some valuable perspective, something that cuts through the daily noise, the scary headlines.
Exactly. While the present certainly feels uncertain, maybe even a bit scary.
Yeah.
The historical data presented here strongly suggests the potential for significant market rebounds following these kinds of conditions. It doesn't mean it's guaranteed, of course, but the historical precedent is there.
Okay, and that leads us perfectly into our final thought for you to consider today. Given this historical pattern, especially the speed at which markets can sometimes flip from oversold to maybe even unthinkable overbought conditions, like we saw in 2020,
Mm.
what specific indicators, maybe beyond just these charts, might you be paying attention to?
Hmm?
What could signal such a rapid, maybe unexpected shift in market sentiment?
That's a great question. What are those early signs?
Yeah, and maybe how might you be thinking about positioning yourself to potentially take advantage if such a significant change in the market landscape unfolds quickly?
Definitely some food for thought as everyone navigates these very interesting times.
Absolutely.
Yeah.
Something to mull over.